Hello everyone, my name is Sherina, and today I'll be presenting a financial ratio analysis of the Coca-Cola Company, one of the world's most iconic and successful beverage brands. This analysis will cover key financial ratios that reflect the company's performance and financial health over the recent years. Coca-Cola was invented by Dr. John Pemberton in 1886 and officially became a company in 1892. It introduced the iconic counter bottle in 1915 and expanded globally by the 1920s. Headquartered in Atlanta, Georgia, Coca-Cola operates in over 200 countries with a diverse portfolio that includes Sprite, Fanta, Minute Maid, and Powerade, continually evolving to meet consumer needs and focus on the sustainability. With more than 500 brands, Coca-Cola remains a leader in the non-alcoholic beverage industry, driven by innovation, market presence, and brand loyalty. Coca Cola's mission is simple yet powerful. It is to refresh the world, inspire moments of optimism and happiness, and create value and make a difference. And its vision supports this mission through six key areas: people, portfolio, partners, planet, profit, and productivity. These pillars guide Coca Cola in creating sustainable growth and maintaining its global leadership. This ratio analysis helps assess Coca-Cola's financial condition using data from its financial statements. It enables us to evaluate performance across liquidity, efficiency, solvency and profitability, and also market valuation. These insights support decisions by investors, managers, and creditors and show trends over time. We will analyze five categories of ratios. First is liquidity ratios. It is to measure a company's ability to meet short term obligations using its most liquid assets. Second, efficiency ratios. It is to assess how effectively a company uses its assets to generate revenue. Third, solvency ratios. It is to evaluate a company's ability to meet long term debts and financial obligation. Fourth, profitability ratios. It is to indicate how well a company generates profit relative to revenue, assets, or equity. And the last one, market valuation ratios, reflect the market's perception of a company's value and performance, often used by the investor. Now let's go into each of the category in more details. Now let's talk about the liquidity ratios. The first one is working capital. It is the difference between current assets and current liabilities. A positive figure means the company can cover short-term debts. From 2020 to 2024, Coca-Cola's working capital has shown noticeable fluctuations. It started high on 4,639 million in 2020 and then declined over the next 3 years, indicating a tightening in short-term liquidity. However, in 2024, it dropped sharply to 748 million, signaling a significant decrease in current assets relative to current liabilities. This declining trend, especially the steep fall in 2024, could raise concerns about the company's ability to meet short-term obligations without additional financing. And then the second one, current ratio, shows how many times current assets cover current liabilities. A ratio above 1 indicates good liquidity. Coca Cola's current ratio has gradually declined over the 5 year period from 1.32 in 2020 to 1.03 in 2024, indicating a steady reduction in its short term liquidity. While the company maintained a ratio above 1, suggesting it had more current assets than current liabilities, the downward trend reflects increasing pressure on its ability to meet short term obligations. The lowest point in 2024 at 1.03 suggests that Coca Cola is nearing the threshold where its current liabilities nearly equal its current assets, potentially signaling a need for improved liquidity management. Next is acid test ratio or quick ratio. It's similar but excludes inventory. Focusing on more liquid assets, Coca-Cola's acid test ratio has shown a consistent decline from 0.84 in 2020 to a low of 0.60 in 2023, with a slight recovery to 0.64 in 2024. This trend suggests that the company's ability to cover its short-term liabilities using only its most liquid assets has weakened over time. An asset test ratio below 1 indicates potential liquidity concerns, as Coca Cola may not have enough quick assets to pay off current obligations without selling inventory. The slight uptick in 2024 may signal early signs of recovery, but the overall downward trend points to growing reliance on less liquid assets to meet short term financial obligations. Now let's move on to the efficiency ratios. The first one is accounts receivable turnover. It shows how often receivables are collected. A higher value means faster collections. From 2020 to 2024, the accounts receivable turnover ratio improved significantly, rising from 9.28 to 13.49. This upward trend indicates that the company has become more efficient in collecting its receivable over the years. A higher turnover suggests that the customers are paying their debts more quickly, which enhance the company's liquidity and reduce the risk of the bad debts. Second one is average collection period. It is the number of days it takes to collect receivables. The lower, the better. The average collection period showed a consistent decline from 39.33 days in 2020 to 27.06 days in 2024. This decreasing trend complements the improvement in accounts receivable turnover, indicating that the company is collecting payments from customers more quickly. A shorter collection period generally reflects positively on the company's credit policies and cash flow management. Next, inventory turnover. It indicates how many times inventory is sold and replaced during the year. The inventory turnover ratio increased from 4.04 in 2020 to a peak of 4.71 in 2022 and declined to 4 by 2024. While the initial rise suggested more efficient inventory management and strong sales, the subsequent decline may point to slower inventory movement, potential overstocking, or a drop in demand. Monitoring this trend is important as a lower turnover can tie up capital and increase holding costs. Still on the efficiency ratios. Next is average sale period. It is the average time inventory sits before being sold. A consistent or decreasing period is ideal. From 2020 to 2024, Coca-Cola's average sale period showed some volatility. It started at 90.28 days in 2020, then improved to 79.38 days in 2021, and further to 77.53 days in 2022, indicating faster inventory turnover in those years. However, this trend reversed in 2023 and 2024, rising to 85.31 and then 91.15 days, respectively. The recent increase suggests a slowdown in inventory movement, which could point to softening demand, inefficiencies in inventory management, or external market challenges. Monitoring this trend is crucial, as prolonged inventory holding can tie up capital and impact profitability. Next is operating cycle. It combines the collection and sale period, measuring how long it takes to convert investment in inventory into cash from sales. Coca-Cola's operating cycle lengthened steadily from 2.30 in 2020 to 3.37 in 2024, indicating that the company is taking more time to turn its investment in inventory and receivables into cash. This prolonged cycle may reflect longer periods to collect receivables or slower inventory turnover, which could strain short-term liquidity and impact cash flow management if not offset by strong operating cash inflow. And the last one, total asset turnover. It reflects how effectively total assets generate revenue. The total assets turnover ratio from Coca-Cola improved from 0.38 in 2020 to 0.48 in 2023, before slightly declining to 0.47 in 2024. This indicates a general improvement in the company's ability to generate revenue from its assets, suggesting increased operational efficiency. However, the minor dip in 2024 could warrant attention to ensure that the asset utilization remains strong going forward. Next, we are going to talk about the solvency ratios. First, time interest earned. It measures the ability to meet interest payments from earnings. A higher ratio, the more severe it is. The time interest earned ratio remained stable between 2020 and 2021 at around 6.3, but it saw a significant spike in 2022, reaching 12.37, indicating strong earnings relative to interest obligations. This peak suggests a year of a high profitability or lower interest expenses. However, the ratio dropped to 7.41 in 2023 and further to 6.03 in 2024, signaling a declining buffer to cover interest payment and potentially tighter financial flexibility in the most recent year. Next is debt to equity ratio. It compares total liabilities to shareholders. The debt to equity ratio showed a downward trend from 3.01 in 2020 to 2.56 in 2023, indicating a gradual reduction in financial leverage and a shift towards a more equity based capital structure. This may reflect improved financial stability and reduced reliance on debt. However, a slight increase to 2.81 in 2024 suggests a small uptick in leverage, possibly due to new debt issuance or a decrease in equity during the year. Last, equity multiplier. It indicates how much of assets are financed by the equity versus debt. The equity multiplier declined steadily from 4.10 in 2020 to 3.57 in 2023, indicating a decrease in the company's use of the financial leverage and an increase in reliance on equity financing. This downward trend suggests a more conservative financial structure. In 2024, there was a minor rise to 3.68, which may point to a modest increase in leverage or change in asset composition relative to equity. Now let's talk about the profitability ratios. The first one is gross margin percentage. It reveals the percentage of revenue that exceeds the cost of the goods sold. The gross margin percentage show minor fluctuations from 2020 to 2024. Starting at 59% in 2020, it improved to 60% in 2021 before dipping into 58% in 2022. However, the company quickly recovered, reaching 60% in 2023 and peaking at 61% in 2024. This overall upward trend suggests improving cost efficiency in producing goods, potentially indicating better control over production costs or stronger pricing over time. Next, net margin percentage. It shows how much of each dollar earned is actual profit. Net margin performance has been more volatile than the gross margin. It rose from 24% in 2020 to a high of 26% in 2021, reflecting stronger profitability. However, it declined to 22% in 2020 Two, and only modestly recovered 23% in 2023 and remained flat in 2024. Despite stable revenue generation, increasing expenses or interest burdens may have constrained bottom line growth, as the company hasn't matched the peak profitability of 2021 in subsequent years. Next is return on total assets. It indicates how efficiently the company used its asset to generate profit. The ROA has remained relatively stable and healthy, reflecting the constant returns generated from the company's asset base. It increased from 9% in 2020 to 11% in 2021 and maintained a range between 10% and 11% through 2024. This consistency indicates efficient asset utilization, suggesting that the company is managing its resources well to generate steady income, which is a positive sign for operational efficiency and management effectiveness. Next is return on equity. It reflects the return generated on shareholders' investment. The ROE charts show fluctuations over the 5-year period from 2020 to 2024. Starting at 41% in 2020, it peaked at 46% in 2021, indicating strong profitability that year. However, it dropped sharply back to 41% in 2022, suggesting a decline in efficiency. ROE slightly recovered to 43% in 2023, but dipped again to 42% in 2024. Overall, the trend reflects instability with a notable spike followed by a gradual decline. Next, we are going to talk about the market valuation ratios. First, earning per share. It reflects the portion of profit allocated to each shares. The earning per share has shown a generally upward trend from 2020 to 2024, rising from $1.81 to $2.47. The most significant growth occurred between 2020 and 2021. There was a slight dip in 2022, but it was followed by a strong rebound in 2023 to $2.48, with a minor decline to $2.47 in 2024. This consistent increase, despite small fluctuations, suggests improving profitability and value generation for shareholders. Next is price earning ratio. It shows how much investors are willing to pay for $1 of earnings. The price earning ratio shows a general downward trend from 2020 to 2023, falling from 30.32 to 23.80, indicating reduced investor confidence or slower earnings growth. A slight rebound in 2024 to 25.19 may suggest improving expectations. The volatility over these years reflects changing market sentiment or earnings fluctuation. Next is dividend payout ratio. It tells us how a percentage of earnings is paid out as a dividends. The dividend payout ratio declined sharply from 91% in 2020 to 74% in 2021 and fluctuated moderately afterward, ending at 78% in 2024. This pattern suggests an initial move toward earnings retention, possibly to fund growth or buffer during uncertainty, followed by a gradual return to higher payouts. Still on the market valuation ratios. Next, we are going to talk about the dividend yield ratio. It shows the return an investor earns in dividends relative to the stock price. A higher yield can indicate an attractive income investment. Dividend yield slightly declined from 2.99% in 2020 to a low of 2.77% in 2022, then rose to 3.12% in both 2023 and 2024. The initial dip might reflect rising stock prices or lower dividends, while the latter increases signals stronger dividend performance relative to stock price or higher payouts. And the last one, book value per share. It represents the value of company's net assets attributable to each outstanding share of common stock. Book value per share increased consistently from $4.49 in 2020 to a peak of $6 in 2023, then dipped slightly to $5.77 in 2024. This growth trend implies consistent earnings retention and asset accumulation, while the small decline in 2024 might suggest reduced profitability or asset write-downs. All of this ratios analysis is based on the data from Coca-Cola's key financial statements, such as the income statement that shows revenue and profit performance. Next is the balance sheet that shows the outlines of assets, liabilities, and equity. The third one is the cash flow statement that tracks cash movement in operations, investing, and also financing. And the last one, the statement of share owners' equity, reflects changes in equity, including dividends and retained earnings. These statements form the foundation of accurate ratio analysis. So, in conclusion, Coca Cola demonstrates strong financial health across all key ratios categories. Its performance in liquidity, efficiency, solvency, profitability, and also market valuation reflects a well managed and globally resilient company. Thank you for your attention.